Rolls-Royce shares jumped as much as 6% on Thursday, touching 1,463 pence, close to their all-time high of 1,532.6 pence. On the surface, the numbers look contradictory. Pre-tax profit for the first half of 2026 slumped 60%, falling to £1.93 billion from £4.84 billion a year earlier. A headline reader could easily conclude Rolls-Royce had a bad half. The market did the opposite, sending the stock to the top of the FTSE 100. The gap resolves once the comparison base is understood. The prior year period included a £679 million gain from a disposal, a one-off that inflated last year's pre-tax figure. Strip that out, and operating profit actually rose 17% to £2.42 billion. The more telling number is underlying operating profit, which climbed 46% to £2.53 billion, comfortably ahead of the £1.84 billion consensus that RBC Capital Markets had penciled in. Revenue told the same story from another angle. It rose 21% to £11.45 billion, well past the £10.17 billion consensus analysts had expected. So the 60% pre-tax decline was never a signal of weakening performance. It was an accounting artifact of a favorable prior year comparison. The underlying business, on every operating measure, strengthened. What moved the share price was not the historical comparison, but the forward one. Rolls-Royce raised its full-year underlying operating profit guidance to a range of £4.7 to £4.9 billion, up from a prior range of £4 billion to £4.2 billion. Free cash flow guidance rose too, to a range of £3.8 to £4 billion, from £3.6 to £3.8 billion previously. Both new ranges sit above what the market had already priced in. The improvement was not confined to one division. Civil Aerospace delivered an underlying operating margin of 25.3%, up from 24.9%, driven by stronger aftermarket performance and improved long-term service agreement terms. Defense jumped even more sharply, to 21% from 15.4% a year earlier. Power Systems improved to 20.3% from 15.3%. Chief Executive Tufan Erginbilgic called it a strong first-half performance across all three businesses, and the margin data across every division supports that framing rather than contradicting it. Management backed the guidance with cash, not just words. The interim dividend rose to 6 pence per share from 4.5 pence, and the company confirmed it has completed £1.4 billion of a planned £2.5 billion share buyback for this year, part of a multi-year program totaling £7 to £9 billion through 2028. A dividend increase alongside a guidance raise reframes the 60% pre-tax headline as noise rather than signal for anyone assessing whether the business itself is improving. The Guardian's reporting on the results points to two structural tailwinds behind the margin gains, rather than a one-quarter fluke. Rolls-Royce has benefited from the jump in defense spending since Russia's full-scale invasion of Ukraine in 2022, and its power generation unit has seen increased demand from data centers used by AI companies. Erginbilgic said the company was still calibrating how large the gas turbine market for data centers could become in the U.S., but that it had already secured future orders. On defense specifically, Erginbilgic said he felt considerably more confident about order visibility after the UK published its long-delayed defense investment plan, which confirmed Tempest fighter jet spending through 2030 and added £5 billion for autonomous weapons. The company is also developing the engine for the Brontanax combat drone that BAE Systems revealed the previous week, positioning Rolls-Royce inside a newly emerging category of uncrewed military aircraft rather than only its legacy engine business. A commentary carried by Inves argued the market is underpricing the data center and backup power growth specifically, noting the stock had broken above 1,420 pence and was holding above its 50 and 100-day moving averages. That reading turns the conventional aerospace recovery narrative on its head. The newer, less followed Power Systems growth story may matter as much to the guidance raise as the more familiar civil aviation aftermarket recovery that investors have tracked for the past 2 years.
The results are not without qualification. Rolls-Royce continues to face supply chain constraints and product cost inflation, and it anticipates continued supply chain headwinds through the remainder of 2026 that will weigh on cash flow and operating profit. Civil Aerospace original equipment deliveries fell as the company aligned output with airframe production schedules, a reminder that revenue growth has not been friction-free. Valuation views diverged sharply even after the same set of results. One widely followed narrative puts fair value at £14.27 against a recent close near £12.61, implying the stock is still around 12% undervalued. A discounted cash flow model applied to the same numbers reaches the opposite conclusion, estimating fair value closer to £9.21 and framing the shares as overvalued at current levels. Both models start from the same guidance raise and reach different destinations because they weight the data center growth assumption differently. Taken together, the evidence supports a narrower reading than either the shock headline or the bullish momentum trade alone. The 60% pre-tax decline was a comparison artifact from a prior year disposal gain, not a deterioration in the business. The underlying operating profit growth, the across-the-board margin expansion, and the raised guidance and dividend all point the same direction. What remains genuinely open is how much of the current share price strength already reflects the data center growth story analysts flag is underpriced, and how that will be tested if supply chain cost pressure does not ease as management expects through the rest of this year.